Welcome to the MarketBeat podcast. I'm your host, Kate Stalter, and in this show, we cut through the noise and give you real market insights from professional investors, traders, asset managers, and analysts. Our guests put the market developments in context and give you actionable information to make you a more successful trader or investor. Let's get started. I began my career in finance as a growth stock trader right around the time that the dot-com boom turned into the dot-com bust. Fortuitous, right? Well, during that downtime, I learned how to identify growth names with fundamental and technical strength. And those stocks really didn't get much into rally mode in 2003, but then really did take off for several years. And there have obviously been fits and starts since then, with the 2007 through 2009 market meltdown being the most extreme. But the current downturn has been a wake-up call for many investors and traders, and it's gotten me thinking. So here's one thing I'm wondering about. Despite all the emphasis on rules for traders, and every trading system has its rules, right? And the advice for longer-term investors to simply stay the course, and the advice for everybody not to layer on a bunch of additional indicators, despite all of that, should traders and investors be adapting their style to these very specific market conditions? Well, today's guest says it's absolutely necessary to shift your tactics, especially as algorithms and greater use of technicals has exploded in the professional investing arena in recent years, and as the current market volatility means it's difficult for any investment or trade to just follow a trend for any length of time. You need to have some alternative strategies in your back pocket, and my guest, Josh Hayes, gives you several ways you can both make money and preserve your capital in this market. And he shares exactly what he's looking for as a signal that it's time to get longer in the market after a significant correction. Now, this interview is chock full of actionable trading strategies and some surprising ideas for signals you might use when it comes time to buy and sell. Get ready to take some notes because there is gold here in today's interview with Josh Hayes of Big Wave Trading. All right, Josh, I want to start with your trading system because every trader, as you well know, they want a system that works. But, just to kind of set this up, you and I met many years ago, back when I was working at Investors Business Daily. And of course, that system calls for traders to get completely out in a bear market. Although I have argued many times in the years since I've left there and become an asset manager myself and done other things, that system is a bit outdated because there are greater ease of option strategies today, along with inverse ETFs and many other ways of hedging in a down market. But start with telling me about the influences in your trading system and how you've evolved over the years.
Okay, it's very interesting because I completely agree with you. When early on in my career, the end-of-day swing trading, it's a similar methodology to the canceling methodology. It's very, very similar, very lucrative, made for an excellent career. But like you said, became outdated. I don't necessarily think it's because of the actual canceling system. I do believe it's more due to just the overall market conditions, algorithms, high-frequency trading, the easy access the retail has to information now, and they're just as slow and calm as it used to be. It's much more volatile, and the machines have mandates based on the VIX, making that methodology very difficult. But still, at its core, it still works. It's just not as easy, quote, quote, as it used to be. And when too many eyes are on a certain methodology, it became very, very popular. It's going to stop working. And anything that works in the market during one phase usually doesn't work during another phase. It can always come back. But unfortunately, I know that there's a saying that you got to master one way to trade, and it's true. You can be a jack of all trades and a master of none. But if you do that in today's market, there's going to be a lot of times that you're just going to be sitting on your hands, which there is nothing wrong with that. Capital preservation right now is of the utmost. I think that basically all new traders need to preserve capital here, not buy the dip until you get proper setups. But when you're experienced and you have to make a living, like I have to make a living to pay the bills, you're forced to find new methodologies. And what you do is you study individuals that are successful. You look and you see what's working, and you put those game plans into action and review them, and you modulate your position size according to the market you're in. And I'm now personally, because I guess I've been doing it for so long, am able to differentiate between methodologies, time frames, and not have like short-term price action or long-term price action interfere with the other methodologies. So I have all the way out to long-term methodologies, which are 5 to 20-year time horizons for individuals. And there's a couple that you can employ. I have quarterly portfolios to deal with the volatility that I built in 2018. So for end-of-day stuff, swing trading, I like to get long, and I have an initial protective stop. And as the stock moves higher, I'll trim and trail. I take profits on the way up and trail my stops higher. But in a very volatile market, I find myself getting chopped out. So on the quarterly models, for instance, I just hold, you can actively trade them. And there's proper setups using moving averages, like the 21 exponential moving averages. I look for squeezes. It's a technical indicator. And then I like my other indicators that are momentum oscillator based, like time segment volume, MACD, and cumulative money flow to all line up. But I keep it simple, because it has a track record of working since late 2008. And I just buy stocks and I hold them for 90 days. Last year, bifurcation started to happen. The last time I saw bifurcation like we saw last year, and I have about 30 YouTube videos on it from last year, was in 2000.
Well, explain what you mean about the bifurcation, just for listeners who may not know what that means.
Absolutely. Small caps were no longer leading, and that's always been the IWM is not really an index that most people follow, but for me, it's everything. Small caps is where I really, when it's leading, the SPY and QQQ, and some of my other technical indicators are lined up, that's when I know I can risk 10R per trade, 5R per trade, 20R per trade, instead of 1R, 0.5R, 5R, depending on the setup.
You had mentioned a few minutes ago, Josh, that you feel like this current market has a very 2000-ish feel about it. You mentioned ARK. This is before we hit the record button today. We were just chatting before the show. And I agree with you. And there's a lot of attention to the fact that the Cathie Woods, the ARK funds are way down. And those are just, in many ways, the traditional growth stocks that you and I both came up learning about and trading back in the day. And when they work, they work. I mean, you can even have an argument that in 2020 and somewhat in 2021, they worked very well until they didn't. So what's your thought on that?
It's the same thing as everything. The 3 out of 4 stocks are going to follow the general market. They all had extremely high price to earnings ratios. Some don't have earnings. They all have amazing revenue growth, but I'm old enough that I've seen that before. And in perfect hindsight, we can see that the run into ARK was similar. I'm about ready to bring you back to 2000, was the run into Ken Hebner's mutual fund.
Oh, right.
Remember how hot he got with his stocks?
Yes.
It felt very similar to that. And now in perfect hindsight, the SPACs, they weren't making any money. They had no revenue. Those were your IPO names back in 1999 that were coming public with no revenue and earnings that were going from 50 to 500. Same things. Also, the altcoins, NFTs are good, but they need utility, right? The amount of NFTs that were going for millions of dollars with no utilities, like all of this is a sign in perfect hindsight. You know that you're in the season, right? You know that, we're getting pretty speculative here. We're in the season, but how far does it go? When does it end? You never know, except for there's one hard metric, hard rule at big wave trading, and that I personally use, and that's you never fight the Fed. And as soon as the Fed started to hike rates, you knew that these price to earnings ratios with higher interest rates, this was completely unsustainable. But if you're trading with rules and you have stops and trailing stops, you would have been getting hit, all your stops hit, and then I was no longer getting signals. And what's funny is that with my end-of-day methodology, I have a lot of people will complain that I have too many long positions during good markets, even though the vast majority work. It's because it can be a lot. They don't understand that. Let's say that it is very possible that I could have 10 long signals in a session, but I'm only going to put like a little bit amount of money into 9 of them, and one of them is a strong enough signal that I'm really pushing the portfolio into. And because the end-of-day methodology is really a hands-off methodology, and I've been around for so long, I can handle that many stocks. But day trading, I could never, ever be in more than 3 to 4 positions at one time.
So let's talk about this end-of-day methodology. What are the signals you're looking for? What is the indicator that something is worth getting a long position in?
Well, no indicator is ever going to work all of the time. It's about placing odds. Like Mark Douglas said, each individual trade is a crapshoot. Anything can happen. But over a series of trades, the odds, the probabilities, the percentages do work out in my favor. Especially right now, I'm currently using a break-even stop methodology that's completely irrational and illogical. But the accounts are green in a very red market, and I'm currently not shorting because on an end-of-day basis, I don't short until the SPY's below the 200 weekly simple moving average. So that being that first. On the end-of-day side, I'm basically looking for similar type signals constantly. It's a variation of a bullish candle over candle pattern. It could be an engulfing candle over candle on a day-to-day basis, a hammer candle, a hammer reversal candle off a strong support or a 52-week low, but it must be accompanied by huge volume truncations on the charts that I look at. I post them on Twitter and Stock Twits for hindsight analysis. Anybody can see these setups. Anybody can see them. But it's normally a variation of a candle over candle off a support level or a 52-week low and or a breakout of a long consolidation period in a healthy market, not in this kind of market. The bounce plays I'll play, but not the breakouts. But the volume truncation, and then there's one indicator I use, and it's not a great indicator, but it is for this methodology when it works, and it's called balance of power. It's a proprietary indicator by Don Warden. It's not anything that's magical. It just, whenever I get my end of day candle over candle signals off that support level or 52-week low or the breakout with a squeeze with multiple other indicators lining up, I know that I can increase size. And for instance, there's been 3 trades recently since I got bearish on this market in November.
Can you tell us what these are?
TWNK, FLXS, and TNP. I believe that I have reviewed them on social media, all 3 of these, with the current percent return. Whenever something I get long hits a post-signal high, I go ahead and review it for everyone so everybody can see, hey, this stock is up 26% in 3 weeks since I went long from this signal. And if I have time, which a lot of times I don't, I explain what the signal was. However, you can look at the chart yourself. And if you do this enough times, you're going to see exactly what I see. But TWNK, FLXS, and TMP have been 3 stocks that have had great standalone signals, even in this tape. But that being said, the overall chart leading into those 3 great standalone signals were not great. They were solid. The signal itself warranted more capital placed into it, but it doesn't warrant 20% of my capital, 50% of my capital. And here's the problem with all 3 of them. Because of the overall market condition, they've been very choppy, and I basically have been knocked out of all 3 of them before they realized that full potential. But TWNK is never going to move a lot. Neither is FLXS. But TMP you wouldn't think of would have either, but shippers got hot, and it did. But unfortunately, the volatility is so intense right now that it's hard for me to get size. It's hard to hold on the end-of-day basis. Right now, my focus is super granular intraday. And even then, I'm trying to go for the swings in the trades intraday, and they're turning out to be scalps because right after I start taking profits on small caps, whenever I start taking profits, I immediately place a break-even stop for educational purposes right now in these accounts. And for the big cap trades I'm taking, once I take my second profit, I place a break-even stop. And today, 2 names I tried to get long, but I'm a conservative entry trader, and I didn't get them. Roblox and Oxy, and they both worked out. Post my chat room alert, post where I wanted to get in. I couldn't get my conservative entry. So I ended up taking a tertiary trade that I was watching, Chevron, CVX, and it was profitable, but the market seemed so heavy early on that after the first take profit, I immediately moved my stops to break even, and that was hit, and I was taken out of CVX.
Not sure what stocks to buy and which to sell? Well, no worries. MarketBeat has you covered. Get the latest buy and sell ratings from Wall Street's top performing, most accurate, and most respected research analysts. That's just one part of what you will receive as a MarketBeat All Access subscriber. You'll also get MarketBeat's new trending stock lists, which monitor social media chatter in real time to help you identify the next GameStop or AMC before you hear about it on the news. MarketBeat All Access also features real-time news, market events, and performance data for your stocks with the MarketBeat portfolio monitoring tool. And you can take a completely risk-free trial for just $1 if you head over to the link we will put in the show notes. You'll get best-in-class stock research tools, performance ratings for Wall Street analysts, real-time news feed, executive support team access, all of this ad-free for just $1 for the first month. Sign up today. The link is in the show notes. So is using a break-even stop, is that something that you use across the board or really just with these kind of day trades?
Just for right now, on the long side, it's just the day trades because the end of day side, I still want to stay within my parameters. So I tell all members, like we had a winner that was just a new long position 2 days ago, SKYH. SKYH hit like 1025 after hours last night. I told everybody, if you're long this stock because of this market, you might as well just take profits now if you're afraid of losing them, and or take some profits on it and then put a stop at break even. However, I'm following my game plan and methodology because I don't want to deviate when the market does change. And I'm still using an original, logical, rational stop until something on the chart tells me moving them all up. But until the chart actually tells me move all your rational, logical stops at a support level that you can see clearly on the daily chart or weekly chart, I go ahead and let it play out. The difference is, like I said, instead of putting 20% of my portfolio into a trade, from buy stop to my sell stop, I only put 0.2R. But whenever I started by using this break-even methodology, even in November, the long only, small cap only, day trading only account that only allows 20% to 25% of the capital to be used per trade, it's up almost, and I post the trader view statistics every day in the chat room and as often as I can on social media. It's up 25% since November alone by using this break-even stops. If I was using my logical rational stops that would be allowed in a hot market in 2020 when stocks were running like GLSI, ACY, if I was getting 100, 200, 500, 1,000% moves intraday, I would use those rational stops. But the vast majority are ending up hitting those stops instead of continuing on further. Redbox continued on further right after shaking me out with a break-even stop. So be it, because the vast majority are hitting those logical stops, and I don't think I would be green. Everybody should be okay with keeping their losses small or break even right now, and that's just what I'm using now on the intraday side. But on the end of day swing side, I have very few trades right now, and when I do get them, the most I'm willing to risk from my entry to my stop level is probably 1% of my account capital. And that's at most right now for the best setups. And normally in a bull market, I'm going to risk 5, 10R initially.
Explain what you mean by that, because I think, again, a lot of listeners are probably not familiar with that term.
Oh, and R is like percent of your account capital. So from buy stop to sell stop, let's say something's at 20 and my stop level's at 19. That's $1 a share. I then figure out whatever is 1% of my account value. And that's the trade size I take on the trade. That way, if it triggers and fails immediately, all hell, because it can happen. I mean, it happens. But luckily for me, it doesn't happen a whole lot, but it does happen. And if that happens, oh no, instead of losing like 5R or 2R in a bad market where 3 out of 4 stocks aren't going to work anyway, I'm going to lose 1R max. But like I said, those 3 stocks I told you about, those are the only 3 trades since November that have even got received 1R of capital. The vast majority are going to be 0.2R. And I know you're like, well, why even go? Why even do it? Because I have to keep some skin in the game with the signals and toe in the water. So whenever that market does turn around and things start working, I'll already probably have a few names really working, and I will then know, okay, we got to increase size here. The Fed is halting rate hikes. They're no longer running assets off their balance sheet. I'm getting signals. Hopefully, maybe I've seen signs of capitulation via the put call, VIX. Sharpies get long, which is the commercial hedgers in the options market. Hopefully, I start seeing flow on the tape that sweeps, $1 million plus sweeps out of the money, long dated options and like QQQ, Apple, Microsoft, Tesla, AMD, NVIDIA, and they keep hitting them day after day after day. Yeah, then I know I'll go full margin with trades if it's a great setup once that happens. But until then, for now, break-even stops work on the end-of-day side, still using the logical rational stops, but modulating, positioning my size accordingly to make sure the portfolio doesn't hurt. And because the Fed is doing what it's doing, quarterly portfolios are 0% invested, 100% cash. Long-term portfolios always keep at least 50% invested because timing the market is a very difficult proposition.
It is. Yeah. And when you're talking long term, it's interesting because I interviewed another gentleman on the show, a trader named Jason Brown, and he was talking about how he treats his long term investments very differently from the trades. And it sounds like you're saying something very similar.
Oh, absolutely. So when the market's selling off like this, on the end of day side and quarterly side, I'm like, oh, no. Wait, stop. Everybody stop what you're doing. Wait. Cash is a position too, whether you want to believe it or not. If you're new, especially, don't worry about making money here. Worry about protecting your capital here, because I know that you see, because here's the thing. Young people, just like me, whenever I was young trading, you don't know how good you have it. You don't have all of these memories of 2000. You don't have all these memories of 2008. You didn't study 1987. You don't have these thoughts in your head. You don't remember how it used to work. So this market is great for the youth, but for the vast majority, it isn't. Those that made the money in 2020, 2021. So cash is a position. Protect your capital. Save that capital. Have a working job. Take that money, keep saving it, put it into the account. And when the market comes back around, that's when you want to put it to work. But on the long-term side, on the other hand, I love this. Bring it on in. Pull it in. I started my long-term operations in a very small select amount, anywhere from 10% to 20% of what I want to buy, in about 9 big cap names yesterday. But I knew it was just a starter. Made it very clear to everybody. I buy on the selling. When in November, I got bearish. First off, when the Fed said inflation was transitory,
yeah,
they are the smartest people in the room. But are you kidding me?
Yeah.
When in history has inflation ever been transitory? Can you find me one economy ever that inflation was ever transitory?
Right. And they seem to convey the meaning that this will be short-lived and temporary, but that's, not right. Not what happened.
Oh, right. Whenever they first initially, right. So whenever they made that, our chat rooms, there's search buttons. You can put search buttons and type in transitory and look at the first time that I mentioned transitory. I was like, oh boy, they're wrong. There is no such thing as transitory inflation. I've studied economics. I know my history around the world. There's never been a time when that's ever been the case. There's no way that can be the case. It's impossible. So then once they actually started to hike rates, I did a podcast in December 2021, and it came out in January 12th, I believe, 2022. And in that podcast, I laid out everything you're seeing happening to the T, everything that's happening. And I made it known to everybody then. I don't know if they kept in that podcast, but I said I would start my long-term operations if SPY ever got to 400. And once it got to 400 yesterday, I started small.
Okay.
Because I expect much more downside short term. But at 380, I'm going a little bit bigger. And if I can get a 50% Fibonacci retracement in this market from the COVID lows, I'm going even a little bit bigger. And if the SPY ever falls 50 to 55% from those highs in December of 2021, I'm going to buy them all of the big caps. I'll go all in my long-term portfolios and Bitcoin, Ethereum, if that happens, because that's the floor normally, a 55% decline. And while most people panic, yeah, bring it on.
Yeah, well, you're right. Exactly that. People panic and they think that it's never going to turn around. I mean, I remember when I had my financial advisory firm, I would have clients who are not traders. They're not interested in the market. They're just investing for retirement. Fair enough. And they were afraid to look at their returns in like 2018. And I'm like, are you kidding me? Do you know what it's done in the past 10 years? Do you have any idea? And they had no clue, just because the news is this constant drumbeat of how awful everything is. And it makes people think your investment account's doing badly as well. Hey, Josh, I'm conscious of the time. I appreciate your generosity with really sharing your methodologies today and giving the listeners some very concrete ways that they can approach their trading and their investing. Tell the listeners how they can get a hold of you, both on social media and through Big Wave as well.
Yeah, absolutely. Well, yeah, the interview is short. I could go on about this market for another 2 hours. So to your listeners, I'm on social media. Joshua Hayes is my name. Big Wave Trading is my handle. I've been doing this on these platforms since I believe that I started my blog spot in 2003. So I have a long-term track record.
How can they find you on social media?
Big Wave Trading, I believe, on Twitter.
Okay.
StockTwits, LinkedIn, Instagram, Facebook, bigwavetrading.com, or Joshua Hayes. If you look up Joshua Hayes, I believe I have a beautiful Maui sunset from my backyard as the profile picture, or Big Wave Trading. It'll have me connected. You'll see that I post every time I take a day trade in my current TOS account. I post the trade and trader view statistics on these social media platforms, along with analysis of any end-of-day swing that's working. And listen, we can talk about losers all day long, but I always cut losses. So there seems to be no point in me ever talking about, oh, well, I lost 1%, lost 2%, lost 1%.
Right.
Because there's never like, oh my God, I lost 50% on this position. My God, like it just never happened.
And those are small losses. And that was the way I was trained as well. Keep your losses small. All right, Josh, thank you so much. Really appreciate you.
Thank you, Kate.
Yeah. And I hope the listeners do reach out to you on social media to learn more about what you're doing.
Absolutely. It was a pleasure speaking with you.
Thanks again for listening to the MarketBeat podcast. Do not forget to subscribe on Apple Podcasts, Spotify, Stitcher, Google, anywhere else you get your podcasts. And you will also find us on MarketBeat.com. If you enjoy the content here, please give us a 5-star review so others can also find all the great interviews and market insights that we bring to you each week. Also, did you know that MarketBeat has a YouTube channel? We sure do. The podcasts are there, as well as tips for getting the most out of MarketBeat and becoming, as always, a better investor or trader.